Hi everyone, in today's video, I'm going to share my exact process of how I chose Facebook stock, how I predicted how much it was worth in 5 to 10 years and at what buy point. And this is based on the book Rule 1 Investing by Phil Town. If you really want to see how the exact process I follow in figuring how much a stock is worth 5 to 10 years from now, at what buy point, then you definitely want to watch this video. In this channel, I help you learn how to grow your money in multiple ways by investing in stocks, in real estate, and invest it in a smart and simple way so that you can fast track your journey to financial nirvana. And if you want to take career breaks or take a sabbatical or build your nest egg or build your kids' tuition fund or leave a 100+ year legacy or do whatever you want with your money because we all deserve a life of no regrets, then you definitely want to be watching this channel. And if you're new to this channel, please be sure to hit the subscribe button and the bell notification so you get the latest and greatest videos coming to you. So let's get back to the video. So in my last video, I went through the process of figuring out how much is Facebook worth in 5 to 10 years from now. I also shared my the Facebook stock predictions of the buy price you could buy it at right now. Now, what process did I follow? Again, I followed the Rule 1 Investing book by Phil Town, where he shares a strategy called calculating the intrinsic value of a company, which is really figuring out how much is a company worth in the future. And as part of that strategy, he also includes a margin of safety as part of the calculation, because the calculation is actually fairly straightforward, but the stock market is completely not straightforward. A company is also not straightforward. So that's why you apply a margin of safety so that you can invest confidently. Let's do a deep dive into this method. So in this methodology, which is the intrinsic valuation of a company, you need a few things. You need its current earnings per share. You need its future earnings per share. You also need its future price per earnings, as well as its rate of return or your required rate of return. Now, in Phil Town Rule 1 Investing, he recommends 15% year-over-year return, but essentially, you can decide what's your rate of return. You might be happy with a 10% year-over-year return, but for this sake, for this calculation, we're going to use a 15% year-over-year return. To get the earnings per share, we just need to go online to Yahoo Finance and we'll search Facebook in the search bar, and then we navigate to the summary tab. And you can see that its earnings per share for Facebook is 7.29. Its future earnings per share. And we can find this in two ways. So you go to Yahoo Finance, pick the analysis tab, scroll down, and you could see that Yahoo Finance is showing, just going to go down here, going down to the bottom, showing that the next 5 years, the growth rate for Facebook is 16.43%. Now, the second method is actually you have to actually look at the financial spreadsheets and scroll down to its stockholder equity. And you can calculate the year-over-year growth rate in the past 5 years, and you could extrapolate and say, hey, is this going to be its future growth rate? And you could do that calculation, but I would caution doing that right now because it's a bunch of number crunching. We're going to keep it super simple. We're going to go to Yahoo Finance and just use its 16.43% growth rate right now. Now, of course, if you have a deep knowledge of the company and the industry and the tech industry, and you think that that's way too conservative, then you could definitely go for something higher like 18 to 20%. But I would just say, let's go back to simple analysis. We're going to stick to the 16.43%. Now, the next number you want to use is the future price per earnings, which is essentially saying how much is the company worth in the future. And we'll use the more conservative estimate. And all this stuff is actually online. We're going to go head over to MSN Money, where we go use their 5-year low and 5-year high price per earnings to get a 5-year price per earnings estimate. You could take the average between the two and you'll get an average price per earnings. So 80.96 plus a low of 17.32 equals, and is 98. 98 divided by 2 is equal to 49. Now you can use a price per earnings of 49, but if you watch my last video where I said you don't want to use it, its price per earnings ratio should be at least no more than double its growth rate. So if its growth rate is 16, I would definitely caution about using the average of the two price per earnings ratio. So I would go definitely even more conservative, and I would just double its price, its growth rate, which is 16%, double it is 32. Now, the next part is you want to figure out what's your required rate of return. In the Philtown Investing Rule 1 Investing book, he does recommend 15% because typically the markets on average can give you 8 to 10% over the very, very long term. So if you're taking on more risk by choosing individual companies, rather than diversifying using an index fund, then you definitely want a higher return. So that's why in the book it recommends a 15% rate of return, which is essentially saying you at least, if you're going to buy the stock, you at least want 15% year over year growth or return on your cash every single year. In the calculation, you also, in Phil Town's book, would talk about a 50% margin of safety, which is essentially saying that for every dollar that the company's worth, you want to buy it on price at 50% sale. What it does is shields you from the unpredictability of the stock market, and also to factor in on the calculation, potential assumptions and errors you can have in the calculation, figuring how much this company is worth. Now, personally, I actually don't use the 50% margin of safety because just the fact that I already lowered its price per earnings from the average of 40 now down to 27, even though its current price per earnings on its forward year looking earnings worth is at 33. I've already factored in a bit of a margin of safety, so I actually don't use the margin of safety because 50% essentially is too high for me. I actually like to use more in the 25% to 30% range, means I'm looking at a discount at least 25%, 30% discount. And I'm not going to share like an Excel spreadsheet because you can actually go to Rule 1 Investing. You just dump in the numbers into this big easy peasy calculator. So it's free, and essentially you dump in what is its current earnings per share, which I shared is in the Yahoo Finance summary sheet. You figure out what is its earnings per share growth rate, which I shared that was 16%, which is what analysts are showing. Figure out, okay, what is its future worth? Actually use 27. Figure out what's your minimal acceptable return on your investment. So you can choose 15 because that's what Rule 1 Investing book recommends. But personally, if you feel like you can go with a lower return on your investment, then you go with 10. But I would say I recommend a 15% at least because you are choosing an individual stock. And then that spits out the future value of that company. So I now want to just show you the different ways you can play with this calculator. So I already showed you, how to get the current earnings per share, the future price per earnings, the minimal acceptable rate of or your return on your investment, how many years you want to project out, and was your I guess future predictions of the growth rate. So in one of the videos I had said, okay, well if you went with a 10% growth rate and with you're looking at a future value of $511 in 10 years time. If you went with a 15% growth rate, you're looking at 796, and then obviously you'd be going for a 20% growth rate, you're looking at 1,000 plus. So that's really how I got these numbers. Now, this is just a quick and easy, dirty way to do this. Now, what's important about this calculator and Rule 1 Investing is that it tells you your buy price, which is really the sticker price. So if you are really expecting like a 20% growth rate, it's saying that if you wanted a 15% return on your investment for at least 5 years, the buy price would be at 606, and a 50% margin of safety would make it at 303. So anything under $300 is a buy, assuming Facebook is at 20% growth rate. Now, of course, you probably the thing about this calculator is that you could play around with these numbers. So, for example, if you wanted, say, 8 years, at least a 15% growth rate, 15% return on your investment for at least 8 years, then all of a sudden the expected fair value of the stock, Facebook right now, assuming it grows 20% for 10 years, is fair value is $398. But of course, you wouldn't buy it at the price. You would buy it at 50% discount at $199. So what I'm trying to get at is you could play around with these numbers. So if you really understood the company like I do, you may not need 50% margin safety and you're okay to buy it at a higher price. But I would just say be conservative. Like 20% is really high, even though it's got a lot going for Facebook shops and WhatsApp. But who can actually expect, like how many people expect Facebook to grow 20% year over year for the next 10 years? So that's why you probably just want to shorten the growth, the number of years it's growing. You probably want to say, okay, I could maybe more realistically achieve 16% growth rate for the next 5 years. I want my return on my investment for the next 5 years to be 15% return on investment. That means the fair market value, assuming that the future price per earnings of this is valued at 27 in 5 years' time, would mean that the fair market value is $206 and the margin of safety at 50%, 103. Of course, that's crazy. It doesn't never drop 103 like forever. So this is why you got to play around the numbers. You got to figure out what you are comfortable with. You know, you could go with a higher price per earnings because typically, here's a rule of thumb. If the earnings per share growth rate is 16% in 5 years' time, the typical PE ratio for that type of growth rate is at least 2 times. Okay, that would be very, very normal. A lot of the tech companies are actually valuated a lot higher than twice the growth rate. If you ever found a growth rate of 16 and it's trading at price per earnings 16, that is like you got to gobble all the stocks up, assuming Facebook ever got to that point. But Apple actually had, I think, one point was like that, but now it's no longer like that. Anyway, sorry, I'm just getting getting distracted. Okay, so you could say 32 price per earnings, assuming 5 years time. Then you could say, okay, well, the fair market value is $244. You could see like this is just a rough estimate. The numbers change given how you play around the price per earnings. Anyways, I just wanted to show this to you to just share what does it mean for the number of years here for the return on investment. Again, like I said, you may want to just say, hey, I'm cool with 13% return on my investment. Then the numbers just change accordingly. And you're like, okay, I don't know, maybe I'll just assume it's 10% because Facebook is kind of slowing down. So I'm going to just see what the fair market value is, and then anything below 200, I might buy it. You know, this is just a great way for you to play around with the calculator. So right now, the company is actually trading around 234. I'm going to date this video again. You put it on your watch list and you watch it when it hits that buy price you want to buy it at. You put an order in the bank and you can say buy when it hits at this price, you buy so many shares. Now, obviously, sometimes if you actually truly use the Rule 1 investing book where you apply the 50% margin of safety, it's probably going to be really hard to buy Facebook at that very, very low price. But that's only because it gives you that 50% margin of safety so that it helps you not lose money like 90% of the time. But that doesn't mean that Facebook will drop ever to that price. So that's why I'm saying you got to choose what margin of safety you want to go with so that you can invest confidently in Facebook. Anyways, I hope you found this video super helpful. If so, let me know in the comments below and give me a thumbs up. Subscribe by hitting the subscribe button below and the bell notification so that you get the latest and greatest videos coming to you. I'll see you next time.